2 summers ago, I watched 5 years of work evaporate in under an hour. I was in a trade that had already doubled my money. Everything on the chart looked perfect. Every pullback had been bought. Every dip had been shallow. And I told myself, the most dangerous words a trader can ever say, this one's different. I'd been right for months, and the market rewarded me for it. That's the trap. When you win long enough, your brain starts to rewrite the rules. The stop loss that used to feel like a safety net now felt like an insult. So when the stock gapped down at the open, I didn't exit. I told myself it would bounce. I told myself the market was overreacting. I told myself I knew this company better than anyone else. The next candle flushed so fast my level 2 screen blurred. Down 5%, then 8%, then 12%. By the time I accepted the truth, the loss was double what I had planned to risk. I sold into panic, hands shaking on the keyboard. I stepped away from the desk and stared out the window for a long time. Not because of the money, though it hurt, but because I knew the real damage wasn't in my account. It was in my head. The market had just handed me the bill for months of slow, quiet overconfidence. That loss didn't break me, but it broke my ego. And that was the best thing that could have happened. Because from that day forward, my number one goal hasn't been to prove I'm right. It's been to protect my ability to trade tomorrow. My name is Ben, and welcome to Trading Psychology Wisdom, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. Because one insight today could change how you trade forever. A few years back, I picked up a book with a title that stopped me cold. 8 to 80. The Next 1000% Stocks and Trends. Everyone Can Ride, by Lindzon and Ivaylo Ivanov. At first, I thought it was just another 10x your money hype piece. I've seen plenty of those. But the deeper I read, the more I realized it wasn't about magic stock picks or secret indicators. It was about mindset. It was about positioning yourself, so when the next big move comes, and it will, you're ready to ride it. Howard and Ivaylo drove home a truth I'd been teaching for years. The market is an opportunity machine, not sometimes, not just in bull markets, always. The catch? You've got to survive long enough, both financially and mentally, to take advantage of those opportunities. One idea from the book hit me especially hard. You don't have to be first to make a lot of money. Early in my career, I thought being first was everything. If I didn't catch the exact bottom, I thought I'd already lost. Truth is, catching the bottom is ego. Catching the trend is where the money is made. Since reading 8 to 80, I've seen this lesson repeat in my own trades, and in the traders I mentor. We don't miss big winners because we lack information. We miss them because we're distracted, biased, or too scared to pull the trigger. And here's the twist. The biggest winners often look the most uncomfortable when they first appear. That's where psychology is tested. And that's exactly where we're going next. Years ago, I caught what would become one of the biggest trades of my career, and almost lost it all, for one simple reason. It started with a company hardly anyone was paying attention to. It wasn't in the headlines. It wasn't in a hot sector. But the price action was relentless. Stair-stepping higher. Tight consolidations. Strong closes. Everything my system looks for. I bought in quietly. No big announcement, no overthinking, just a clean setup that met my rules. The first month, it was up 20%. 2 months later, 50%. By month 4, it had doubled. That's when psychology got tricky. When you're sitting on 100% gain, you start imagining what life looks like if it doubles again. You stop asking, how can I protect this? And start asking, how much more can I squeeze out? I watched this exact mindset take out a trader I mentor, we'll call her Maria. She had a similar setup. Same momentum. Same clean breakout. But instead of managing the trade, she started managing her dreams. New car, new house, early retirement. When her stock pulled back 10%, she didn't sell. At 20% down, she said, it'll come back. By the time it was down 40%, she'd given back almost everything. I recognized the look in her eyes because I'd seen it in the mirror. The truth is, the chart doesn't care how far you've come. It doesn't care what you think you deserve. My turning point came when the stock had its first big gap down on heavy volume. Not catastrophic, just enough to make me uncomfortable. And that discomfort saved me. I scaled out half my position that day. 2 weeks later, earnings missed expectations, and the stock dropped 35% overnight. I still made a life-changing return. But more importantly, I learned the difference between making money and keeping money. That one discipline, defining exits before entries, has saved me more times than I can count. It's not glamorous. It doesn't make headlines. But it keeps you in the game long enough to catch the trades that change everything. That trade, and watching Maria's unravel, drove home one of the most important truths I've learned in over 15 years of trading. The big returns, the kind that change your account and your life, they don't come from comfort. They come from doing the thing that feels hardest in the moment and managing it with discipline once you're in. That's what today is about. Not the perfect stock screen, not the magic chart pattern, but the mindset that lets you spot the real opportunities and ride them without letting fear or greed throw you off. I'm going to share exactly how the principles from 8 to 80 by Howard Lindzon and Ivaylo Ivanov have shaped the way I trade and the way I mentor other traders. We'll connect them to the most common psychological traps I've seen ruin good setups. And, more importantly, we'll walk through the tools I use to stay calm, systematic, and confident, even when the trade is anything but. This isn't financial advice. It's what I've learned from my own scars, my wins, and the lessons I've watched other traders pay dearly for. If you use it well, it might just keep you in the game long enough to catch your next 1000% move. If I had to boil down everything I've learned, from my own trades, from mentoring, and from 8 to 80 into one sentence, it would be this. In the market, the real money is made. Climbing walls of worry, not hiding under them. Most traders wait for certainty. For the headlines to turn positive. For the analysts to upgrade. For the stock to feel safe. By the time all that happens, the easy money is gone. The walls of worry are those uncomfortable setups the book talks about. The hated industries making new highs. The stocks everyone swears are overvalued. The names you personally don't want to touch. They feel risky, but they're often the first signs of a major trend. The key is to have a process that lets you climb with control, clear entries, defined exits, and position sizes that keep you in the game. Because climbing without a rope is gambling. Climbing with a plan is trading. If you take nothing else from this talk, take this. The market is an opportunity machine. Not sometimes. Not just in bull markets. Always. Lindzon makes this point crystal clear in 8 to 80. In any 10-year stretch, hundreds of stocks will post 1000% returns. The question isn't whether those opportunities will exist, they will. The question is whether you'll be ready to take them. Most traders aren't. Not because they can't read a chart, but because they don't preserve the one thing that matters most in this game: capital. Both kinds, financial capital and mental capital. I've seen it over and over in mentoring. A trader gets hot in a bull run, over-leverages, rides the market down in a correction, and spends the next year digging out of a hole. By the time the next monster trend comes along, they're either broke or so gun-shy they can't pull the trigger. From a behavioral finance perspective, this is loss aversion at work. The tendency to fear losses about twice as much as we value gains. Kahneman and Tversky proved it. Losing 100 hurts about as much as gaining $200 feels good. That imbalance makes traders defensive at the exact moment they should be aggressive. In my own trading, I've learned to flip that script. During drawdowns, my job isn't to chase my way back. It's to protect my ability to trade the recovery. That means smaller size, tighter stops, and sometimes sitting in cash while the market shakes itself out. Because here's the reality: you don't have to nail the bottom. You don't have to be first in line. You just have to still be standing with your cash and your confidence intact when the real move begins. That's the opportunity machine at work. It never stops running. But it only pays the traders who are still around to plug in. One of the most counterintuitive lessons from 8 to 80 is this: the trades you're most uncomfortable taking are often the ones with the highest upside. Think about it. A stock hitting a fresh 52-week high in an industry the media says is dead. A company you personally can't stand. A chart that's already up 50% in the past 6 months. Most traders skip those. They tell themselves they're being disciplined. In reality, they're protecting their ego. They don't want to risk being wrong in public or proving themselves wrong about something they already decided. I've been there. I once ignored a breakout in a beaten-down shipping stock because I knew the industry was doomed. The chart said otherwise. So did the market. That stock doubled in 3 months without me. This is confirmation bias in action. We look for information that supports what we already believe, and we filter out what doesn't. In trading, that bias is expensive. The solution? Build a bias check into your process. If a stock meets your technical criteria, but you feel resistance to taking it, flag it. Ask yourself, is my hesitation based on data or on story? If it's story, I take the trade. Because I know other traders feel the same discomfort, and that's exactly why the move can run. In mentoring, I call this embracing the cringe. It's not about buying garbage. It's about recognizing that discomfort means you're looking where most traders aren't. And that's where the market hides its asymmetric opportunities. Howard and Ivaylo's 52-week high list works because it forces you into this zone. By the time a stock's on that list, the market is already voting with price. You don't have to love the company, you just have to trust the price action and manage the risk. If it feels uncomfortable, good. That means the crowd isn't there yet. It sounds ridiculous at first, buying a stock that's already up 50% in the last 6 months and expecting it to keep going higher. But the data says not only is it possible, it's probable. In 8 to 80, the authors point out a truth most traders can't accept. Stocks that have gone up sharply are more likely to keep going up, at least in the short to intermediate term. And it's not just opinion. Jagadish and Tipman's landmark 1993 study showed that the top-performing stocks over the previous 3 to 12 months tended to outperform over the next 3 to 12 months by an average of 12% a year. The problem? Momentum feels wrong to buy. Human nature tells us to buy low, sell high. But in markets, low can go lower, and high can go way higher than you ever imagined. I see it all the time in mentoring. A trader says, "It's already run too far, I'll wait for the pullback." That pullback never comes. The stock keeps climbing without them, and now it's up 150% from where they hesitated. Why is momentum the ultimate contrarian? Because most traders are wired to sell strength, not buy it. When you buy strength, you're stepping in while others are taking profits, and before the next wave of buyers pushes it even higher. The trick is not to chase blindly. Momentum needs structure. I want to see a breakout to new highs from a tight base, on strong volume. That structure gives me a clear entry and a logical stop. In my own trading, I have a rule. If a stock meets my breakout criteria and it's on a 52-week high list, I take the trade. Even if my gut says it's gone too far. Because my gut is usually late. Price is leading. Momentum is uncomfortable. It's counter to how we shop, how we negotiate, how we value things in daily life. But in the market, that discomfort is a signal that you're not following the crowd, you're ahead of it. If there's one part of 8 to 80 every trader should engrave on their desk, it's this. Your survival depends on 3 things: timing, exits, and size. Howard and Ivaylo call them equity selection, exit strategy, and diversification or position sizing. I call them the 3 pillars. Pillar 1, timing. You can be right about the story and still lose money if you're wrong about the timing. That's why I look for breakouts to new 50-day or 52-week highs from strong bases. It's not about catching the exact low, it's about putting money to work when momentum is in your favor. And when the breakout fails, I'm out. No drama. No, maybe it'll come back. Pillar 2, exit strategy. This is where most traders fall apart. They lock in gains too early because they're afraid to lose them, or they hang on too long, convinced they can't be wrong. My rule? Decide before entry where I'll take partial profits, where I'll take full profits, and where I'll cut losses. In the heat of the moment, your brain will rewrite your plan. Having it in writing keeps you honest. Pillar 3, size. Position sizing is your shock absorber. Trade too big, and every tick feels like a punch in the gut. Trade too small, and even your winners won't move the needle. I size so that a stop out doesn't damage my confidence, because confidence is as important as capital. I've mentored traders who thought risk management meant just having stop losses. It's not. Stops are the seatbelt. The pillars are the frame of the car. They hold everything together when the market swerves. Get the pillars right, and you can weather drawdowns without losing your ability to trade the next setup. Get them wrong, and even the best stock picks will feel like casino bets. One of the hardest skills in trading is knowing when the party's over. Not when the price is already down 50%, that's obvious. The real skill is catching the shift, when the trend still looks strong. In 8 to 80, Howard and Ivaylo make this point clear. Trends don't die because of valuation alone. They die when expectations change. And you can see that change in how the market reacts to news. If a stock delivers what looks like great earnings and it drops, that's not noise. That's the market saying, we wanted more. I've lived this. I once held a high-flying software stock, 6 straight quarters of beating estimates. Quarter 7? Still a beat. But the stock gapped down 8% on heavy volume. That was my cue. I sold the next morning, even though headlines were still glowing. 3 months later, it was down 40%. This is where traders get trapped by anchoring bias. They cling to old information, old price levels, old narratives, because letting go feels like admitting they were wrong. But in markets, staying wrong is far more expensive than being wrong. When I mentor traders, I give them a simple tell. If good news drops the stock, and bad news crushes it, the uptrend is over, or the easy money part is gone. You don't have to catch the top. You just have to step aside before expectations flip completely. Because once they do, the same momentum that carried you up will work twice as hard on the way down. In trading, there's comfort in the crowd. When everyone's buying the same stock, reading the same analyst reports, cheering the same breakout, it feels safe. But safety rarely delivers 1000% returns. Howard and Ivaylo put it plainly in 8 to 80. The only way to make big money is to be right about something almost everyone else is wrong about. That doesn't mean being contrarian just to be difficult. It means spotting moments where the price action is telling a story the headlines haven't caught up to yet. I remember a setup in a sector the media had written off, solar, back when it was dead money. The charts didn't care. Names were breaking out to 52-week highs, volume exploding, my system lighting up with buy signals. It felt wrong, which is exactly why it worked. By year's end, some of those stocks had tripled. This is where fear-based errors and social influence traps collide. Fear-based, because taking the trade risks being the idiot who bought into a hated industry. Social influence, because every voice around you says you're crazy. The way I navigate this is simple. I separate my opinion from my process. If my process says buy, I buy, even if I hate the story. If my process says sell, I sell, even if I love the story. I've seen too many traders try to predict when the crowd will change its mind. You don't need to know when. You just need to be positioned before they do. The crowd will eventually follow the tape. When they do, you're already sitting in the position, adding to a winner, and watching them pay you to be early. Big returns live in that gap, between skepticism and acceptance. It's not comfortable, which is exactly why it's so profitable. The beauty of these principles from 8 to 80 is they're not just opinions. They've shown up in decades of data, and in every bull and bear cycle I've traded. Momentum works. Jagadish and Titman's 1993 study, they analyzed US stock data from 1965 to 1989. Result? The top 10% of stocks ranked by past 3 to 12-month returns outperformed the bottom 10% by an average of 12% per year over the next 3 to 12 months. That's the statistical backbone behind the 52-week high list. Discomfort. Pays in mentoring, I've seen traders pass on clean breakouts simply because they didn't like the industry. One ignored a setup in airlines during awful press. 3 months later, that stock was up 90%. That's bias costing real money. Preserving capital creates staying power. After the 2020 COVID crash, the traders who scaled down size and cut losers fast were ready to buy into the recovery. One caught a 220% move in a semiconductor stock in the next year. Those who rode the drawdown without risk control. They were still digging out of losses while the bull run passed them by. Trends end with expectation. Shifts. Look at Netflix in early 2022, a market darling for years. Then, a small miss in subscriber growth expectations, and the stock gapped down 20% overnight. That was the moment the expectations flipped, and the long-term trend ended. Being right when others are wrong. Solar in 2013, written off by media as dead money. Yet prices broke out to 52-week highs, and some names tripled by year's end. These aren't one-off stories. They're proof that the edge isn't about predicting the future. It's about recognizing patterns in psychology and positioning yourself where those patterns create opportunity. In my own trading, and in mentoring hundreds of traders, 3 traps show up again and again. They're not just mistakes, they're account killers. 1. Confirmation and anchoring bias. Passing in a breakout because you know the industry is doomed. I've seen traders ignore perfect 52-week high setups in sectors like solar, shipping, and airlines, only to watch them double or triple. Price is the vote that matters, not your opinion. 2. Loss aversion. Psychology tells us losses hurt about twice as much as gains feel good. That pain pushes traders to sell winners too soon and hold losers too long. Howard and Ivaylo are clear: you need both capital and confidence to ride the next big trend. 3. Overconfidence. A few big wins, and suddenly you think you figured it out. That's when stops get skipped, positions get oversized, and the market humbles you fast. The 3 pillars of risk management are built to keep you humble and solvent. Spot these traps early, because if your psychology breaks, your process will follow. Avoiding these traps isn't about willpower. It's about building systems that take the decision out of your emotional hands. 1. The bias check rule. If a stock meets your technical criteria, but you feel resistance because of the sector, the CEO, or the story, flag it. Ask yourself, is my hesitation based on price action or personal opinion? If it's opinion, take a starter position with proper risk controls. Discomfort usually means you're early, and early is where the edge lives. 2. Pre-commit your exits. Before you enter, write down exactly where you'll cut losses, where you'll take partial profits, and where you'll let the rest run. Not in your head, on paper, or in your platform notes. That way, in the heat of the moment, you're executing a plan, not negotiating with yourself. 3. The capital preservation trigger. When the market corrects more than 7 to 10%, automatically reduce position size. Not because you're scared, but because smaller size protects both capital and confidence. That way you're ready for the next opportunity instead of sidelined from damage. 4. The 52-week high watch list. Keep a dedicated list of stocks hitting new highs, even in sectors you don't like. Review it daily. It's not about loving every name. It's about recognizing where the market is voting with real money. 5. The weekly review. At the end of each week, ask yourself, which trades followed my plan? Which trades broke the rules? Did I pass on anything purely because of bias? This reflection compounds skill the same way reinvested profits compound capital. Let's pause here. I want you to be brutally honest with yourself. When was the last time you skipped a trade that met every rule in your system just because you didn't like the story? When was the last time you sold a winner too soon, not because your exit signal fired, but because you were afraid to lose the gain? When was the last time you ignored your stop loss because you knew it would come back? If any of those happened in the past month, you're not alone. I've been there. Every trader I've mentored has been there. The difference between those who keep repeating the same mistakes and those who break through is simple. They stop defending their biases and start defending their process. You can't control what the market will do tomorrow, but you can control whether you show up ready, with rules that are stronger than your impulses. If there's one thing I want you to take from this, it's that the market will always offer opportunities, but only to the traders still standing when they appear. That means protecting your capital, protecting your confidence, and protecting your process from your own biases. Now it's your turn. Write down the biggest takeaway you got from this talk in the comments. Share it with a trader you know who's been struggling. And if this helped you, like the video, share it, and subscribe so you don't miss the next one. Master your mind. Master the market. Trade with confidence and live with calm.